On May 11th, 2026, we saw a pretty profound contradiction rip through global markets. You had a naval blockade in the Middle East, triggering a broad risk-off deleveraging that actually dragged Bitcoin down. But right at that exact same time, a relatively obscure decentralized exchange token spiked 51%. What we're really looking at here is a landscape where the traditional rules of digital assets are starting to fracture. In this explainer, we're going to dig into the shifting incentives beneath those headlines. We'll trace exactly how macro pressure is forcing a radical structural evolution and how digital value is actually anchored, structured, and sustained.
Let's start with part 1, the Great Market Contradiction.
Over a single weekend, diplomatic failures in Islamabad basically culminated in a U.S. naval blockade of the Strait of Hormuz. Naturally, the immediate market interpretation was a flight from risk. But here's the interesting part. Bitcoin didn't act like a safe haven commodity or digital gold here. Instead, it behaved almost exactly like a high-beta tech stock, sliding 2.6%, mostly just to cover margin requirements over in traditional commodity markets. Meanwhile, the capital that actually stayed inside the digital asset ecosystem aggressively concentrated elsewhere. It drove Osmosis, a decentralized exchange token, up over 51%. To understand why capital is concentrating so intensely, we need to zoom out and look at the macro forces creating this global liquidity vacuum. Which brings us to part 2, geopolitics and global liquidity. Those events in the Strait of Hormuz represent a severe, immediate constraint on global supply chains. Keep in mind, the strait handles roughly 20% of the world's oil, so the blockade instantly sent Brent crude surging past $104 a barrel. Right alongside that, China's producer price index rose to 2.8%. Put simply, factories in Asian manufacturing hubs are facing higher energy costs, and they're passing those costs straight on to global consumers. For financial markets, this combination is a huge flashing signal for a persistent inflationary threat. It severely diminishes any likelihood that the Federal Reserve is going to cut interest rates in the near term. What we're witnessing is something analysts call correlation convergence. This external pressure from rising energy costs forces institutional investors to sell off their most liquid assets, like Bitcoin, just to shore up their traditional portfolios. This dynamic effectively strips away all the retail froth and reveals exactly how the surviving capital behaves. You see, in an environment where capital is scarce and expensive, it completely stops chasing speculative ideas. Instead, it aggressively seeks out definable valuation anchors.
This leads into part 3, the cost of sovereignty.
For years, the dominant thesis in this space was that every protocol needed to operate its own independent blockchain. But in a high-interest rate environment, the overhead of maintaining independent security and liquidity just becomes a crushing burden for a lot of projects. Osmosis clearly realized this shifting reality. That 51% surge we talked about wasn't a retail pump. It was driven by Proposal 1029, which was a strategic move to merge into the larger Cosmos hub. By establishing a fixed-rate conversion of roughly 1.998 Osmo tokens per 0.0355 ATOM, they created a classic merger arbitrage opportunity. It's essentially a way to profit from the price difference during an acquisition, which establishes a hard price floor. And crucially, this acquisition is designed to be funded by Osmosis's own $5 million in annual decentralized exchange revenue, rather than just printing more inflationary tokens. The consequences of failing to adapt to this new environment are pretty stark. We can juxtapose Osmosis's survival by absorption strategy directly against Akala. Akala was once hailed as a primary decentralized finance hub, but they failed to iterate their legacy model quickly enough. As ecosystem subsidies dried up and major exchanges started delisting the asset, mechanical sell pressure triggered a severe structural decline. It dropped the asset over 51% down to just a fraction of a penny. It turns out, sovereign brand equity means very little when your operational debt starts outpacing your revenue.
Moving on to part 4, engineering institutional yield.
Now, while protocols are merging just to survive, public institutions are fundamentally changing how they interact with these assets. They aren't passively holding anymore. They're actively locking up supply to manufacture predictable corporate yield. Take the strategic positioning of SUI Group Holdings, a NASDAQ-listed company trading under the ticker SUIG. In their first quarter earnings, they disclose holding 108.7 million SUI tokens. But what's really critical here is how they're using those tokens. SUI controls roughly 2.7% of the entire circulating supply, and management confirmed that substantially all of it is actively staked on the network. They've shifted entirely away from high-risk decentralized lending, moving toward native protocol staking instead. This is generating roughly 5,200 SUI in daily yield for them. By removing this massive chunk of supply from the secondary market just to secure predictable on-chain cash flow, corporate treasuries are effectively creating a structural supply shock, and that naturally amplifies upward price pressure whenever demand increases.
Let's look at part 5,
the privacy paradigm shift.
So, why would institutional demand for a network like SUI increase in the first place? Well, it comes down to utility, specifically a fundamental pivot in how the digital asset space approaches privacy. SUI recently announced upcoming confidential transactions, and that actually triggered a 290% spike in trading volume because it solves a direct commercial necessity. They're utilizing zero-knowledge proofs to create what we call compliant privacy. Think about corporate payrolls or supply chain payments. A business literally cannot operate on a public ledger if it means their competitors can see exactly what they're paying their suppliers or their employees. They absolutely need the ability to hide sensitive data, but they still have to retain the capacity to provide audit proofs to regulators to comply with anti-money laundering laws.
Because of all this, we are watching a pretty profound bifurcation in market psychology right now. On one side, you have this quiet, highly systemic progression of institutional yield hunting and enterprise compliance building. On the other side, retail capital remains heavily distracted by short-term event-driven hype. Take the Paris Saint-Germain fan token, for example. It surged nearly 20% simply because the club secured a spot in the UEFA Champions League final in Budapest. It's a perfect illustration of speculative capital chasing sporting performance, completely detached from the very real structural economic shifts occurring elsewhere in the market.
Which brings us to our final section, Part 6, Ecosystem Gravity.
When we synthesize all these events from May 2026, the overarching theme driving this volatility is what we might call ecosystem gravity. The digital asset landscape is really beginning to mirror the early 20th century consolidation of the traditional banking sector. When the macroeconomic weather turns cold, when liquidity is aggressively drained by geopolitical conflict and sticky inflation, these specialized, sovereign protocols start to realize they simply cannot survive the overhead of independence. They're forced to make a choice. Either merge with larger entities that possess deeper liquidity and robust security, or face systematic elimination by the market.
This structural evolution leaves us with a fascinating and frankly critical tension to watch going forward. As smaller chains abandon their sovereignty to become components of unified institutional hubs, we have to critically evaluate the long-term implications here. As this consolidation accelerates in a high-interest rate environment, does the original vision of a truly decentralized internet of blockchains fade away? Or is this wave of consolidation simply the inevitable structural cost of integrating with a mature global financial system?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.